We are watching the global semiconductor memory market hit an $800 billion peak, dwarfing its historical averages. Memory now represents nearly 50% of all semiconductor revenue, a massive increase from its historical 30% average. Yet, despite that massive scale, roughly 90% of the world's supply comes from exactly 3 companies: Samsung, SK Hynix, and Micron. When 3 players control the physical storage of data, they hold veto power over the base layer of the modern digital economy. Then came the massive AI boom, and with it, a relentless demand for high bandwidth memory, or HDM, the only hardware fast enough to feed modern AI processors. This chart compares commodity memory margins against HBM. With a massive price premium, HBM pulls in operating margins of 72%. But there's a physical trade-off. 1 gigabyte of HBM consumes 3 times the silicon wafer space of standard DDR5. To chase the summit of AI profits, the incumbents actively cannibalized their own commodity production lines. They left a structural vacuum right in the middle of the mainstream market. That void is exactly where China's CXMT moved in. While the legacy cartel focused on AI, a sanctioned company from Hefei quietly stepped onto the abandoned factory floor. Western export controls had cut CXMT off from advanced EUV lithography machines, placing a hard technological ceiling on how advanced their chips could get. So they bypassed the EUV bottleneck entirely. They took their existing technology and flooded the exact mainstream DDR5 market that the cartel had just vacated. The strategy immediately secured enterprise-scale traction, including a 20 billion yuan supply deal to put their memory into Tencent's massive server deployments. A 2-generation technological disadvantage stops mattering when you are the only supplier left producing the foundation. In 2024, CXMT was running about 100,000 wafers a month, a fraction of the output from the Korean giants. This graph tracks CXMT's manufacturing trajectory, rapidly accelerating to 350,000 wafers by 2026, nearly matching Micron. Layering financial returns over this capacity, CXMT posted a 1,688% profit growth. The public market validated that growth immediately, backing CXMT in a record-breaking 66.6 billion yuan IPO. In just over a year, their share of the global market jumped from 3% to 8%. With a capacity target closing in on Micron, the 3-decade dominance of the Big Three is meeting its first significant structural challenge. Raw manufacturing volume is proving that a company can still gain massive market leverage even while trailing on the technological curve. But we have to map the macroeconomic reality honestly. The West still holds the technological high ground. Without EUV lithography, CXMT still trails the industry leaders by roughly 2 full process generations, which means a higher cost per bit to manufacture. And the high-margin HBM market driving the AI boom remains heavily defended. Analysts estimate China's domestic memory won't match Korean high-end products until at least 2030. CXMT hasn't won the technological war at the summit, but they have successfully secured the middle of the board. The financial industry is already reacting. Morgan Stanley, the exact bank that helped finance the current cartel's crown, recently issued a downgrade of Samsung and SK Hynix. Morgan Stanley cited CXMT's mainstream volume as a structural risk to the dominance the Korean giants have held since 1992. The market is bifurcating into 2 distinct layers: an exclusive, low-volume summit controlled by the West, floating above a high-volume base controlled by the East. Notice the upward pressure. In manufacturing, whoever controls the foundational volume eventually exerts pricing influence over the entire ecosystem. The legacy players are finding that a technological fortress is only as secure as the market foundation beneath it. When that base is abandoned, the bankers are often the first to price the shift.